Hello, I'm Glennie, and today I'm going to be talking about the Aberdeen UK Smaller Companies Growth Trust. So I think one of the ways that our team has a competitive edge is related to the history and longevity of the process that we have. So we've now run the same investment process focusing on quality growth momentum for 25 years in the UK space. And we've seen that through many cycles of different market environments. And one of the key parts of our investment process is also using an in-house quants tool called the Matrix. And this really helps us in terms of acting as a screening tool. And it is constantly flagging to us the type of companies that it believes are quality growth momentum and will make an attractive investment case for us. Now, this is only a part of our process, and then it's about taking that insight and really doing the fundamental work on those companies. But it means that companies don't fall out of our universe. We're always aware of what's happening, not just in the companies that we own, but also companies that we don't currently own. And we really use the Matrix in a few ways. So, it's really helpful for screening that whole investment universe, and therefore being able to actually invest in quite a broad investment universe. So smaller companies, there's a huge number of businesses that we have the opportunity to invest in, but really narrowing that down and doing the fundamental research with quite a small, compact team. I think the other thing the Matrix is really useful for is portfolio construction. So we should always be looking at keeping the fund weighted average Matrix score high. And so we do that as an input in terms of looking at position sizes. The Matrix score is always considered. I think another thing that's been a competitive advantage for us in difficult market environments is that what the Matrix also does really well is looks and gives us insights as to the factors that are performing or are not performing in a general market context. So for instance, through 2022, we saw a very different environment where actually, valuation factors have performed very well. Quality has been much less of a focus for markets. And I think we've seen some really encouraging signs in recent months that the Matrix has flagged up to us. So for instance, we've seen that earnings revisions has really been a strong performer again, as has growth as well, and value has been less of a focus. And that gives us more confidence that actually, if we continue to be able to identify companies who are seeing strong growth and importantly, earnings upgrades, those will be rewarded by the stock market. I'd add a couple of other competitive advantages of the team, just not only in that longevity of process, but also in the global nature of our team. So within the Aberdeen Smaller Companies team, we have funds looking at UK, but also Europe and global. So we have analysts covering all these areas of the world. And I think particularly while markets have been very macro top-down driven in recent years, that's really helped us to get some good global insights from within the team, and also some of those stock specifics and read acrosses that we get from various businesses. UK smaller companies, markets and investing has been particularly challenging. And what we've seen over the last 18 months, and which has continued for longer than we would have wished, is that markets have really been macro-driven and top-down. And we've seen, particularly in the UK, that high, persistent, sticky inflation being a real standout. And if you look versus Europe or US or other major geographies, being much higher and more persistent. And I think also there is a challenge to say that the Bank of England have been too slow in raising rates. We're still seeing high wage growth as well in the UK, and that is a challenge relative to current inflation, which means that we hopefully are getting to the top of that rate cycle, but it feels like there could still be one or two more hikes to come. Key for us actually in that macro outlook, which we think will be a positive for smaller companies and also importantly for growth investing though, is seen as being the point where we start to see inflation cycle reverse. And we've now had two good prints of inflation coming down in the UK, the first in the middle of July and then the second in the middle of August. And we're now seeing more of a pathway in terms of visibility of inflation coming back down again. The interest rate cycle still perhaps has a little way to go, but also it feels like we are hopefully getting to the point of starting to see that peak out and then over time reverse. We think both of these things would be real positives for UK markets relative to other geographies, UK small cap as we see a bit more confidence coming back in and more risk on appetite, and also importantly for our style of investing. Another challenging point that keeps going on in markets at the moment is the question of recession or not. And I think one of the challenges that we do have in that is that it sort of keeps getting kicked down the road, and almost until we get a recession, we're always going to question whether one is still coming or not. I think that's another thing that markets will take some time to get over. And as we see some more continued, not standout economic data, but sort of better than feared, we hope that that will let people put the fear of recession slightly behind us. But even in this environment, it feels like it's going to be in and about. And for us, that's okay. We feel that that delivers more of a neutral style environment. And with inflation hopefully coming off and interest rate cycles peaking, we think that's a more attractive asset class environment for smaller companies. UK, and particularly UK small cap allocations, are really at low levels. And I thought it was a positive I saw in the Bank of America Merrill Lynch survey this week. Actually, the UK came out as the top geography within Europe in terms of people's intention over the next 12 months to be over or underweight. And I thought that was a really positive factor in terms of people's sentiment towards those UK assets. And if we look at some of the valuations, I think it's been very true that the UK has been cheap relative to other geographies for some time now. But I think it's important to look at the underlying of that. So UK valuations, we think, are pricing in a lot of negativity relative to other regions. Actually, the earnings picture has been quite resilient. So if we look at the FTSE 250 space, despite there being some FX headwinds and interest rate headwinds, we've seen a real turn in that earnings revisions from the end of the year. And at the moment, I think we're getting about as many upgrades as downgrades, and that's been on an improving pathway since around December. And I think the other thing we would flag out is just the valuation. So if we take FTSE 250 as an example, I believe that if we use dividend yield as a valuation metric, only 2% of the time over the last 30 years has FTSE 250 been this cheap relative to FTSE 100. And we think that provides a really attractive entry point for investors. I think the last thing I would say is that we are hopefully seeing a bit more overseas interest in the UK market again, which it seems like we've lacked for many years. If this video has piqued your interest and you'd like to hear a little bit more about the Aberdeen UK Smaller Companies Growth Trust, please visit our website or click in the link in the description below. Thanks for listening.